If you don't like and subscribe, I'm gonna
hunt you down.
What I'm gonna do. Yeah, I'm gonna hunt you down and steal all your ETH proof of work coins. I think that's working. We're back. We've got Alex from Umami here. Obviously, we're big fans of the product and the whole project itself. So, welcome. I'm sure you've got better things to be doing with your time than spending it with us two idiots. So, thanks for joining us.
No, this is exactly where I want to be right now. We're big fans of blocmates.
That's good to hear. Good to hear.
Thanks,
I think before we get started, it might be a little bit further out, and people would have had to do a little bit more digging. But I think a lot of people in our community, in our following, have probably listened to me babble on about you guys for for a couple of months now. So, but yeah, how did you get your start here? What's your role at Umami, and what is a kind of idiot's overview to Umami?
Okay, all right. I mean, there's different questions there, so I'll try to give concise answers to each. So I'm the CEO of Umami Labs. So Umami Labs, think about Uniswap Labs, just for example, as a model. We are a US-based technology services company. We're contracted with Umami DAO to provide a whole variety of end-to-end services. We help with product design, build the products, provide marketing, business development, and so forth. And I got started as a member of the Umami DAO community. I was a contributor in the very early days. I think for those who have been following us, certainly for our OG community members, they know that we had a totally different model when we first launched. We were an Ohm fork called 02 Ohm, based on an anime show, Darling in the Franxx. We were sort of just a meme Ohm fork. And I got involved quite early. I was not a founder or a core team member, but I was helping with marketing. I was attracted to the project at the time because I was bullish on Arbitrum, and they were developing considerable protocol controlled liquidity on the Arbitrum network, which seemed like the beginnings of an attractive opportunity. Although the tokenomics of Ohm forks, for those who know, were very unattractive to me, right, and eventually to the market. So, when Olympus DAO and the other forks started to unwind, there was kind of a little bit of a crisis in terms of direction and focus for the project. We were hit just like everyone else was, and that's when there was some turnover, and I became project lead. And that's from there we really started to pivot dramatically. So now that you've heard the backstory, I'll give you a very brief overview of who we are now, and then we can talk more. But we're sort of the opposite of the meme, non-led 02 meme-based Ohm fork that we once were, and we now have our core principles. I think a lot of folks are familiar with the hashtag real yield meme, or whatever you want to call it. In fact, I just had a cool interview with Defiant News. They're writing an article about real yield. So we originated that phrase, and the basic vision for those who don't know is that we think that the era of ridiculously high 200% or 1,000,000% APYs through token emissions in DeFi are over. And that ultimately a DeFi project is just like any other enterprise, is going to be judged on its ability to have a product that adds value and generates revenue for the project, and that ultimately has some way of passing that value it creates on to its community, right? Or else what's the point of holding the token? So one core principle is that we share 50% of most of our protocol revenue streams right now. 50% go to go to our stakers, our long-term stakers, denominated in ETH, right? So it's not Umami emissions; it's actual, ETH revenue from our products. That's really foundational. We have a capped max supply of our token at 1 million. And to be clear, we're already over 650,000 in circulating supply. And we don't include the Umami in our own LP in that calculation. So there's very little room for any further dilution. And we have, as a result, other key conviction here is a zero emissions philosophy. We won't incentivize anything with emissions. If it can't stand on its own, we don't do it. So that's the gist of our philosophy. And then just to cover kind of product and strategy very briefly. Right now we have a vault that provides basic, near market neutral USDC based exposure to the GMX exchange and the stream of exchange revenue that GMX creates. So we call it our USDC vault. Deposit USDC, collect USDC yield, withdraw USDC, at will. And essentially what it's doing under the hood is providing liquidity to the GMX exchange. And I think most listeners are very familiar with GMX. Yields are great. They're denominated in ETH. So, we're looking at 25% plus APR in ETH often from the GLP token, which is the liquidity token for GMX. Sometimes it's more like 15%. We use mycelium. They used to be called Tracer. They're now mycelium. They're non-liquidatable hedges to hedge out the market risk of from the BTC and ETH in the GMX liquidity pool. And that's our first product. We're following that next month. September 15th is our target date for launch, which is alpha, by the way, with a vault denominated in ETH that will basically track the performance of ETH and provide a similar amount of yield, and a vault in BTC that's otherwise the same. And then the only other thing I'll add, we have other products in the pipeline, and our real goal here, and I think this is really important. We talked about our sort of philosophy about sustainable value generation and good tokenomics, but that's really just part of our vision. Our longer term vision is that we think that DeFi is only going to really succeed if it can see mass adoption, and we don't believe that mass adoption is going to come from more retail, mom and pop, grandma aping into degen plays on L2. We think that it's going to be institutional capital, and to do that, you need the right strategy, and that's why we build USDC vault, BTC vault, ETH vault. That's basically all that institutions are open to right now, but certainly 10-20% APR in real yield is very attractive to them. We are currently building some pretty cool regulatory compliant wrappers to allow us to market to institutions in the United States and other major markets. Obviously, in light of some stuff that we've seen in the news, regulatory compliance is going to be a major theme in DeFi. So that's our long-term vision. We have some really, really cool partnerships in the works with major TradFi and CeFi entities, and I think I'll stop there.
Alex, in terms of the relationships that you've embarked on, obviously you've got GMX. You're effectively piggybacking off what GMX are doing, and then you creating the value around that. Is that correct? Does that apply to all these other protocols that you guys have got on your website? Is it the same principle?
Sure. So right now, our initial, I think broadly speaking, any vault strategy we have is going to have, underlying products that are the source of the yield, right? And a major source of our ecosystem value add is that, we take, what you could call DeFi primitives or DeFi bricks, right? Assets on chain that generate sustainable yield, but maybe are a bit hairy. And we package them into strategies that are really tailored, particularly to institutional capital as a target market. So, in that sense, are we piggybacking off GMX? Sure, right? That's like kind of the idea is we want to see more TVL, being piped into DeFi generally, and certainly onto Arbitrum, and into partners like GMX. We don't want to, one thing, we've made clear and chatted with GMX about this, we don't ever want to be a one project play, right? This is our first suite of products. We're going to build more. We have some other ideas. We can talk about that later for what's going to come next. But, we're happy to be, building on top of GMX.
Yeah. So the same will obviously apply with Dopex, and I mean, I see that you got the I mean, what is the relationship that you guys have with Dopex and Jones specifically? Just for the record, they are projects that I've been very close to, and that's why I'm asking. I'm just curious to,
It's a great question. So let me answer that. So you're looking, I assume, at our landing page, right? And you're seeing a list of partners. Here's the context, and I'm actually glad you flagged that. We did work with Jones and GMX to get whitelisted to build some, kind of like auto compounders, products similar to auto compounders, but they don't dump the native token. They just stake it single-sided, right? So we called them super stakers. We built those products. And, they're basically ready to launch. But to be honest, this is no negative reflection on, Jones or Dopex in any way. We love those guys, and I think there's many other ways that we can end up partnering with them. But right now, what we found is that there is so much traction around this sort of institutional capital focus with just the core BTC, ETH, USDC vaults that we just don't want to distract from that, right? Like we would honestly rather, we've done modeling and we could get a lot of revenue from creating the super stakers for Jones and Dopex right now, but it would just complicate our narrative. And we're just getting so much traction. There's so much excitement. It's not the time, right? So, they are partners. We like them. We can work with them in many ways. They're building cool stuff. We're probably not going to go live with those products right now.
Okay. Horses for courses, of course. I mean, that's what it is. Yeah, absolutely. Makes sense.
Alex, forgive me for saying this, but you seem a little bit too rational to be involved in DeFi.
A compliment rolled into an insult. I like
that. Looks can be deceptive. What kind of guy quits a corporate job to join a waifu-themed home fork in a non with a 0-2 avatar for months to bootstrap this? I don't know if I'm rational at all. But I'm not kidding. But
at what point did that? I mean, there must have been a cliff for when you left like a traditional role to kind of jump in. Was there like a turning point there that kind of pushed you down the rabbit hole further?
Yeah, that's a great question. So I was doing marketing with 0-2 Ohm, which then turned into Umami while I was still a contributor. There were obviously Ohm forks, kind of pretty sharp downturn, December, January. A lot of kind of cosmic discussions at that point on the team about the future of the project. Now, at that point, I was working a corporate job. I was a financial reporter at Reuters News. That had been my job for about 7 years before this. And, I was working that from home because it was COVID. And then I was also working with Socket, which is a really great interoperability protocol. Doing some marketing for them. So there was kind of a lot of different things going on. I knew that I was bored of, just the corporate world, didn't want to keep doing the same thing. So I wanted to get into DeFi. And basically, when the opportunity to be project lead came up for Umami, and I realized now I can finally push through all these major changes, like literally making the tokenomics the opposite of what they were, trying to find a real revenue model, that was really exciting. And I basically quit my corporate job that day. And Socket's an incredible team, but I told them I don't have time to keep working with them either. And I've just been all in with Umami since then.
Wow. Kudos. That's cool. What was the kind of transition from the Ohm style fork to what we see as Umami like now? Obviously it's completely different. And it's don't get me wrong, I think one of the silver linings out of the whole Ohm fork mania was the bonding mechanism is a ingenious bootstrapping mechanism for people who want to stick around and see the projects through. It's also kind of a double-edged sword, isn't it, right? Because you've got all the projects that use that bonding mechanism to kind of just run away with funds. But there's been a few, like you had Magnet DAO on Avalanche. They kind of spun up into Vector Finance. They've kind of been putting away as much VE-JAW and VE-PTP as physically possible, so they could play a real key role in kind of governance on Avalanche as that ecosystem develops. So there has been some really good stories about how the bonding mechanism has led to decent sized treasuries, so these protocols can then spin up and go and build something of real value, like you guys have done, Vector have done. I'm sure there's a few others I'm missing as well.
Yeah, so I mean, let's break down sort of what works and doesn't work about that bonding model. I think the main criticism I would levy is that all of these forks were based on the reserve currency concept, right? That was ideated by Ohm. And look, I'm not going to speak to whether Ohm's strategy will work or not, but I think it's clear that if there's going to be a reserve currency of DeFi, then there's definitely not going to be 40 reserve currencies, 3 on every chain, right, for every fork. And yet the market was, acting as if, all of these emissions, because you have the emissions, to bonders, you bonding and then you're compensated in the token, and then you stake, and then you receive emissions at some ridiculous 100,000% APY. During the heyday of Ohm fork season, right, the market was acting like these emissions of the token were, not dilutive in any way, right, to the claim on the treasury backing, as they called it. Again, because of that currency concept, like, oh, this can be a relatively stable currency, and you only need backing to be like a percentage of the total amount of reserve currency outstanding. And again, that just did not apply at all. It made no sense with the forks in particular. So, I mean, bonding or something like it as a mechanism for capital raising is, as classic as it gets, right? Like issue new tokens, raise some Ether stables to, cover funds. That's just like an IPO, or, ICOs are really not that different. So that's fine. I think that, what was missing was, any model of what to do with it, and emissions certainly are not a value add. They're the opposite. So, the truth was that, the emissions from the time that, 0 to Ohm, our project launched, to when we finally stopped emissions, were just strictly dilutive, right, to the people who had provided capital. Luckily, there was enough capital to give a decent runway for us to build products. And the good news is that if you find product market fit in DeFi, the TVL scalability is so much that we actually do think, people who bought in early might still come out okay, right? But you have to, in the future, like, it's obviously crucial that projects have a clear business plan in mind if they're going to do that. Otherwise, it will just be value destructive.
Mm-hmm. Yeah, completely agree. So let's get on to kind of products. So you've got the kind of, so just for kind of anyone who's kind of struggling to understand the vault, just as a high level, it's you can deposit USDC into the vault currently. Is there still allocation available for? Is it capped?
Not right now, but there will be soon. Yeah, so I think the way to do this is I'll start with kind of the user experience of the vault, and then we can talk about the mechanics behind the scenes, right? Because those are sort of two different things. And our goal, of course, right, one of the major value adds of the vault is that the user experience is designed to be, very straightforward and streamlined. So, you deposit USDC, you get a receipt token called GLP USDC. That token is, fungible and tradable. And at any time you can, choose to withdraw from the vault. So you just, return your receipt token, and then you get out the USDC you deposited plus the APR. And what's critical, right? I mean, one of the main value props is that most stablecoin yield farming, you're getting APR in some kind of emissions token. Here, you're getting it in USDC. So it is actually, a real sort of sustainable form of yield denominated in USDC. And, the base, and then before I get into sort of the mechanics behind that, the key points are, for depositors, the vault is hedged, so it's designed to be as close to market neutral as possible. We are not telling people that this is truly delta neutral. This is not. If you want true delta neutrality, stay in stable coins or keep cash under your bed. There is some volatility inherently because the underlying assets have that exposure, and we're using the most optimized hedging strategy we can to manage that. We have backtesting data people can check out and kind of see what level of volatility to expect. But the idea, of course, is you're seeing, that day-to-day volatility that the hedges are minimizing, and then long-term upwards trend from the yield. And you mentioned the caps. There are caps. The reason for that is that, this is not, we're the furthest thing from a cash grab, get rich quick sort of project. We want this, product to actually work. We plan to eventually develop enough, really strong real world performance data that we can, use that as we, penetrate the institutional market, right? So we're going to scale slowly. We're going to do it in a way where we don't, overwhelm, our underlying, platforms that we use with so much TVL that it affects performance negatively. And so we're doing this stepwise. Our expectation is maybe get to $10 million TVL by end of August. And then we're going to launch 2 more vaults that we can talk about later. But once they launch, it'll actually allow us to scale our entire product ecosystem more quickly.
Okay, so the kind of the 20% UST yield that everyone was climbing all over everyone for. It's go check out Umami, people. But
it's so inconvenient that it's just the case that the strategy we're using generates around 20% APR on average. Like, we didn't take that as a meme. We weren't like, oh yeah, we want to look as much like Terra as possible, but it just works out that way. The yield varies based on the underlying performance.
It's a good narrative to tell, though. It's a good story to tell.
That's true.
It's a good marketing tool.
That's true.
Alex, in terms of products, sorry, Grant, in terms of products,
go on.
how are you guys discerning? And hopefully there's a bit of alpha here for the crew that are watching back home. I mean, how do you guys actually sit down and decide? Like, obviously GMX was kind of like it was so obvious. I mean, in terms of their sustainable model, and the whole real yield thing is something that we've been talking about quite a lot on our streams. And if you are in fact the one that coined that phrase, then you and I are brothers. That's all I can say, because it has reached that point where, like, ladies and gentlemen, we've reached a point where we need sustainability. We need, revenue generating entities and products that will allow us to be sustainable in the space. Now, how do you sit down from GMX, for example, and identify future products? And is there anything on your horizon at the moment?
Absolutely. A great question. And yeah, I agree. I mean, if you take, this was a discussion I was having yesterday with someone who was writing an article on real yield. The problem with something like, hashtag real yield as a meme is that as soon as people see that, oh, this is desirable and everyone's interested in this idea, every project under the sun wants to claim they have real yields, right? And the truth is that it's not just, our rewards token is ETH or USDC and therefore it's real, right? That is a prerequisite, but there's a lot of other criteria that have to be met for it to be a serious, sustainable strategy, right? And so the main thing that I'll say is that, with every single product that we build going forward, right? Just like with our native token Umami, we want every product that we build to be informed by this sort of real yield philosophy, which means that first and foremost, we want to find sustainable revenue streams. And, even something as seemingly simple as that can be deceptive because there are so many hidden risks in DeFi, right? That can produce the impression of generating revenue when in fact you're getting wrecked and you don't realize it, right? Like the people who think that you can simply farm Uniswap V3, that's an example, right? Of, it's a strategy that looks like you are generating, APR, but in fact, because of the impermanent loss, which is accentuated by concentrated liquidity, you're losing money on the underlying. So, we would never want to pick a product where, they are generating some kind of, ETH or USDC yield, but it's not from a real revenue stream tied to a product they built that is scalable, right? Anyone can issue tokens, raise ETH, push it out the back door and call it yield. That is not what we're interested in. So, the main thing here is we spend a lot of time with each vault that we build. We We, make sure everything's really thoroughly audited. We live test the crap out of it before we launch. We back test it, using Monte Carlo analysis with our partner Balance. So we want to make sure that once we build something, the underlying platform, that it's sourcing yield from has longevity, has, significant TVL to begin with, right? Because we're not going to dilute our depositors by, increasing TVL so much it pushes down the APR on the underlying platform. We want to make sure that it has the ability to keep scaling over time. And we want to make sure that, any sort of hidden risks, because every form of liquidity providing comes with some kind of risk. We want to make sure we understand it really well, and we want to make sure that we can hedge it out, or it's like an acceptable part of the product. So if the risk is just that, it's totally correlated with ETH, well, that's fine for a product that is supposed to be deposit ETH and get yield on ETH. And look, I'm going to be honest with you guys. There are very, very few products in DeFi that fit those criteria. We think GMX has a ton of potential. They're doing extremely well. They have, one of the most attractive, structures for providing liquidity and generating, revenue from that, which is denominated in ETH if you, provide liquidity through GLP. They're getting a lot of attention. We think that, there's TVL between Arbitrum and AVAX. It's already more than 250 million for GLP, and it can scale from there. So just building on that, there's a lot of upside. To be honest with you, the next product that we are going to launch, and we've put this in our roadmap now, I don't want to give too much alpha, but we want to go to sort of the most de-risked, most foundational, and most scalable source of yield in DeFi, which is ETH2 validator nodes. That is, our view is if we can solve for some of the questions around uncertainty with respect to the beacon unlock, that we would have, an infinitely scalable product with a very de-risked revenue stream. So that'll be our second product suite. You can imagine kind of different levels of market exposure and hedging, based on that yield source. And we want to market that really heavily to institutional capital. There's a huge interest in that. And we don't, beyond, this GMX-based product suite, maybe a couple supporting products that are sort of smaller, but help our ecosystem, and then these core ETH2 node vaults. That's really all we're focusing on right now, because again, to get something right, you don't just throw together the smart contract. There's so many other moving parts that we assume at least a quarter, right, 3 months for a product launch cycle.
Just on that, just my last comment on that before Grant asks a question is that I think we've come to an interesting crossroads in DeFi from the perspective of sustainability and obviously the whole real yield, as opposed to this ideology, because it was never something that was in demand, and I think the demand is there now, and people are kind of tired of. I mean, listen, there's always going to be the DJs, there's always going to be those players. It's kind of like the weeds in the garden, but if we want a proper garden here, we have to have sustainable and lucrative businesses that are operating in the space. And essentially what you're doing is that you're one of the first that have put up their hand and said, we want to go for the long haul. We want to find projects that are sustainable. And it doesn't surprise me that you're only looking at, the one or the two or the three, because there really aren't any, there are some, but they haven't proven themselves yet. And it just shows you where we are right now. And even though I'm tired of hearing we early, we definitely are early when it comes to, the sustainability model and what you guys are doing. So well done for recognizing that and saying enough of the DJ and stuff. Let's actually get down and do some business and do what DeFi was meant to be.
You're absolutely right. Honestly, for us, for Umami, for a variety of reasons, the really extreme market drawdown between May and July was kind of a blessing, because I think that before then we were talking about this real yield philosophy, but there was still this view that, well, I could do that, or I could just do some degen play and 5x and get out. And so there was still this sense that we didn't have to confront reality yet, right, as an ecosystem. And then the drawdown forced that on us, the truly Ponzi projects got, fully wrecked, which, shook out the sector, I think, in a healthy way. A lot of other projects, then started pivoting towards real yield. Lots of projects are sort of focusing on now using the language of, here's our revenue, here's our revenue sharing model, here's our business plan. It's starting to sound a little bit more professionalized. But like you said, it's real. Very few have succeeded fully yet. It's, I think many of them still will fail because this is a whole other topic. But it's one thing to just say, oh, I value, the approach of being professional and trying to generate real revenues. Try executing on that at the operations level, right? And that's a completely different question. So a lot of projects, that were like really smart, just like degen and non-devs, and are now trying to make this transition. You don't have someone with at least some Web 2 startup operations experience, some background like that can actually run this in a serious way. It's going to be really hard. So yeah, I agree. There's really, I think, only 10% of projects that were out there prior to the drawdown really look like they're going to make it. But as you said, I think it's awesome for the ecosystem because now the good ones are going to be much more visible. We finally have projects that will be attractive to institutional capital. People will talk about them in a more serious way. So I think it's good.
And just ETH chain, or are you guys looking at other chains for the future? Is that not on your not on your agenda? Just ETH.
Great question. So look, when we think about sort of our grand strategy, if you will, we are, ETH maxis, and of course that includes the L2s. So, right now we are, very focused on Arbitrum network. We, obviously when we do, ETH2 nodes, we'll be sourcing yield from mainnet. We believe that ultimately a ZK EVM is going to be a really important scaling solution. So when the time is right, we'll definitely be looking at opportunities there. So long term, we just think that kind of the existing network effect and the decentralization of Ethereum makes it an obvious winner. But we're not purists about that at all. We think there's room for other chains. We had a really great conversation recently, a couple of sort of ongoing conversations with Ava Labs, the Avalanche team. GMX operates on Avalanche as well. So we'll definitely go ahead and build, we're planning to build a product on Avalanche that just is essentially the same as Arbitrum, and we can capture that TVL from GMX there.
Makes a lot of sense.
Mm-hmm.
So let's get to the kind of topical kind of question that's like on the tip of my tongue. So how, like from the outside looking in, it's a complete shit show. What is the regulatory landscape like if you're trying to navigate through those murky waters at the minute?
It's confusing, but I think that the confusion has led to a general sense, at least from what I'm seeing, of overreaction in one direction or the other, right? So there are people saying, DeFi is dead, everything's going to be, these sort of permissioned walled garden chains, and that we just need to, we've seen, right, a number of DeFi projects sort of proactively blacklisting, lots and lots of people from their front ends just to try and preempt regulatory scrutiny. That's one view. It's one that myself and others on our team disagree with. A fully permissioned, gated, centralized blockchain isn't blockchain. It's not clear what the value add would be of that technology at that point. So we don't think that's the direction things are going to go. Simultaneously, the other thing you hear is, basically, the feds are out to get us. Let's hide under a rock. We need to, we need to decentralize everything, remain totally anonymous, et cetera, et cetera. And, I actually do think that there's value just sort of from a basic operational security perspective and sort of talking to people like that and kind of getting their perspective on how to make your project as resilient as possible. So that's actually fine, but that's obviously not a winning long-term approach, because the truth is, we already have groups like the Blockchain Association, right? Like there is money in DeFi, there's institutional capital in DeFi, there are professional teams in DeFi. It's a little ridiculous to think that we can't just for context, think about think about every Web 2 company that did something so innovative that there was not an existing regulatory framework to accommodate what they were doing. What was Uber's strategy for years, right? These guys are not locked up in the annals of, Guantanamo Bay, right? Like, they're okay. It's fine. They hired attorneys. They came up with a legal strategy. They paid lobbyists. They informed regulators, and they're doing very well. We can do that too. We will. And so, the goal here for Umami is decentralization is great. It's a meaningful technology. It's a meaningful innovation. So, we're not going to just throw up our hands and say, we give up on all efforts to be, decentralized at all. Just regulators, please tell us what to do. We want to participate in a meaningful debate, educate, regulators about the value out of the technology, the potential, benefits, economically, particularly in the U.S., and eventually establish, DeFi, just like every other industry, is someone that is regulated in a way that allows us to innovate.
Yeah, I think shying away from the conversation and hiding under a rock and making everything completely anonymous is going the complete wrong way about it. And that might be counterintuitive to a lot of people listening in the audience, but it's inevitable that it's coming. We're going to be dragged in kicking and screaming regardless. So the conversations need to be led from within inside the industry and not kind of just a blanket ban because from these people who don't necessarily understand what they're talking about. So what do you think of like projects like, so, have you seen the Aave ARC? So they're kind of institutional, like KYC, AML pools and things like that. Do you think that has a place?
Let me share some thoughts, and obviously all of this is fluid and developing. You raised a key point, which is that regulators right now just don't understand the value add of blockchain and DeFi and decentralization, and so the regulations they're trying to kind of push are just treating us as if we were traditional financial security, right, without kind of accommodating for what smart contracts can do. So basically, I think what needs to happen is that, there's going to probably need to be, here's what Umami's doing. We're building regulatory compliant on-ramps for institutional capital into the products that we're building. We're actively market segmenting with our compliance strategy, meaning that we will create regulatory compliant wrappers for the US market. If we move into another market, we'll do the same, that accommodates their concerns, their regulators' concerns. We think that those on-ramps themselves will need to have, KYC and AML compliance. Frankly, the first step for us is to actually create what will probably be a CFTC registered fund in the US that can just serve as, a compliant pass-through into our on-chain vaults, and there'll be, KYC, AML at the door. Now, what's important to us, though, we don't want, as I said, we don't want to just completely capitulate to, centralization without, having a meaningful discussion with regulators. And so I think what would be ideal would be, these different compliant on-ramps that comply with their jurisdictions, so that, institutional capital in the US has to be AML, KYC compliant, et cetera. But to also continue to have permissionless on-chain vaults for those who are in jurisdictions where they can use them, right? In other words, we're not going to preemptively put up gates everywhere and, start blacklisting anyone who ever, had a third-order relationship with Tornado, right? We want to keep things as permissionless as possible, and then, increase overall TVL in the space with these sort of select on-ramps that, will meet, for those institutions, meet their regulatory requirements. And I think what happens long-term, the vision here would be, my belief at least, it's just how things work. Once you get billions of, blue chip institutional capital on chain, you've won the regulatory fight. I mean, these guys, like, where does the SEC, let's be honest, or CFTC, get a lot of their regulatory, input on some of the regulatory structures they create, right? Like, obviously, the traditional financial sector has a lot of influence and input on those debates. So if we win them over as an ally who's invested in us, that's going to really help increase our voice. So we want to, do that successfully while preserving trustlessness, permissionlessness, decentralization at the smart contract level as much as possible.
Yeah, it makes an awful lot of sense. Again, you're talking a lot of sense for someone who started out working from an own fork. But no, it's you're ticking all the right boxes for me, and I'm pretty sure people who are listening or watching now, they'll be, particularly the retail folk, and I know our audience very well, so they'll be thinking, well, if that institutional capital is coming in, how does that affect my Umami holdings? so is there a positive correlation there? Because we've been I sat down in front of a spreadsheet for around 3 hours today to try and work out projected volumes on Hero Network and what a fair value token price would be based on their revenue share from their kickback model, with all trades on their platform and 50% coming back to stakers. Surely there must be something similar. Not that I'm dying to sit in front of another spreadsheet for a couple of hours to try and work it out, but if we looked at projected TVLs, projected kind of performance fees, surely you could kind of surmise or estimate or speculate on a fair price for Umami. Not that founders like talking about token, but
Sure. So what can I say? I can say that we have an internal model that models out to August, September 2023, month by month, based on expected timing for product launches and expected TVL scaling. And I'm not going to give you guys a price, but how do I put this? Basically the protocol revenue is a function of the fees on the vaults, and the vaults themselves. We are, as I said earlier, we choose them based on their scalability. So I think let's kind of look at some ballparks here. The GMX based vaults, right? So we're gonna have the USDC, ETH, BTC vaults, 3 of those together, which source their yield primarily from GMX and then hedge it. They could, I think, very realistically, internally we expect to scale to about 150 million TVL for those, by Q4 2022. And we believe GMX has a ton of upside. They're going to launch, as you guys probably know, a peer-to-peer synthetics trading platform. They're going to launch X4, which is going to be a sort of unique AMM model. And so, TVL scalability for them, it can really run, right? And our vaults can run with them. I think the general, reasonable thesis is that people would rather have, ETH, BTC, or USD exposure to the yield on GMX rather than just the direct liquidity pool exposure through GLP, which is sort of this changing index. So I think we can we can be a supporter of GMX, and also a lot of their TVL into their liquidity pool will be coming through us. So pick whatever numbers you think are reasonable for how much we can get from 150 million just on GMX, but also really critically, don't make the mistake of thinking that that's all we are. We really, really, really are serious about the ETH2 node based vault strategy. That is our next product. We're aiming for Q1 2023 as our launch for that. By then, we're going to have, just for context, we've been open about the fact that we are in early stage discussions with Circle, right? Who can be a major distributor and provide direct on-ramping into our product through their Circle account. They have lots of institutions that they work with as clients and who are users. We're talking to another centralized exchange that I think is probably even more of a household name. You've almost certainly used it, than Circle, to provide the same function for us. And we have a lot of one-off relationships with, major asset managers. So with that in place, and with the compliant KYC AML wrappers that we're building, that allow us to market to the US, once we have those ETH2 vaults built, the TVL scalability for our purposes is basically infinite. I think that's 60 billion TVL in beacon nodes already. So an extra billion wouldn't dilute yield. So an extra billion wouldn't be a crazy target for us by mid-year 2020 for this product.
Damn, Maybe we should. Maybe I should sit down. We'd love to get some kind of content around Umami, and then because you guys can't obviously speculate, but we can. So maybe we should sit down and go through that and write up an article around that. I'd love to do that.
We could give you our model and just pull out like the specific number assumptions, but give you the framework for how we're calculating it. That could be cool. And I'd like to see what you
Yeah,
say.
for sure.
Cool.
For sure. I think we're getting close to the end of the time, but just I've been thinking about this quite a lot the past couple of days. Just as a kind of outside from Umami, do you think there's going to be an awful lot of chaos going into the merge?
Yeah, I do. I think that there's probably another market drawdown in store, which is fine by us. I mean, I don't know if I should say this, but personally, I'm going to be setting up limit orders to take advantage of that, for Umami and for other good projects when that happens. So I think that there'll be some chaos. I think there's a lot of confusion around the unlock and what will be liquid and what won't that will bubble up. So yes, I do, but I'm pretty confident, as are most of the folks that I've talked to, that ultimately this is going to be really bullish for ETH long term. So any chaos and any drawdown is to the advantage of long term holders.
Yeah, I'm of the same opinion. I think I've seen a few exchanges already posting that they're going to have to halt withdrawals and deposits just over that. I think we're going to stream it, Jerry.
Yeah,
if I haven't already mentioned that, and we'll just we'll watch the chaos ensue, watch the panic, and then hopefully watch the jubilation at the end. But yeah, is it anything new around Jerry before we let Alex go off? And,
I think it's really we've been telling this like what do we do at Blockmates? People ask us what do we do, and what we do is that we actually tell stories about what's going on in the space, but more importantly around the people and the businesses that they're creating. And it's really cool to be able to sit with you today. Like, I mean, obviously, I've been hearing a lot about Umami, like a lot of our community members, they've been very bullish about obviously the product and the rest of it. So, it's been quite close to me over the last month particularly, and it's really cool to obviously meet you and then put the context of this product in line with what I believe to be the future, of the space and what is long overdue. I mean, we all love to talk about, how amazing bull markets are and the rest of it, but no one can actually put value to how amazing it is to be in a bear market and to see this kind of stuff come to the fore, and you guys are one of those. So it's been really cool to have you on, and been amazing to watch you grow, and we can only wish you the best, and hopefully we'll get you back in 6 months time, and then we'll be at 1 billion hopefully TVL, and we can compare prices.
That would be pretty cool. Yeah, well, I really enjoyed this chat. I feel like you guys are definitely looking at things very similarly to us, and I'd love to stay in touch. I appreciate the opportunity.
Absolutely. Right, thank you everyone, and if you don't like and subscribe, I'm gonna
hunt you down.
What I'm gonna do. It's too late over here for me. Yeah, I'm gonna hunt you down and steal all your ETH proof of work coins. But yeah, thanks again, Alex, and thanks again, everyone. We'll be back. You can tell how unprofessional I am. Probably Wednesday, Thursday, or Friday. One of those days. All right, thanks again.